This is a video about building SP 500 Index beating portfolios using the SP 500 Analyzer application provided by Polaris Investing. We will be using the watch list area of the SP 500 worksheet of the SP 500 Analyzer app. Now, to set up for that, I've gone ahead and selected, assuming you watched other videos and know what I'm talking about here, but I've gone ahead and selected none for my watch list and clear out my watch list, start off with a blank watch list. Well, the idea of beating the S&P 500 index is discussed often in the financial press. And recently, Joel Greenblatt, professor at Columbia University, and he's also a very successful hedge fund manager at Gotham Funds. He recently made a presentation on passive versus active investing, in which he discussed this idea of building an S&P 500 index beating portfolio. So to set that up further, I'm going to play back a portion of a video that was recorded in mid-January of 2019. So if you want to go watch the full video, I suggest you go out to YouTube and search for it.
And we sat down to try to figure this out. And we actually came up with a strategy a few years back to try to address the drive to passive. And part of addressing it was to sort of partially give up. And so what we did is we set up something we called Gotham Index Plus. And what we did was we said, you know, for better or worse, most people use the S&P 500 as their mark for whether they beat the market. So we said, you know what, we're going to start there. And so if someone gives us $1 in this mutual fund, we just recreate the S&P 500 bottoms up, all the stocks in the S&P 500. We don't think we're charging for that part. It's pretty easy to do. But then we buy 90 cents more of our favorite S&P stocks on top of that, and we short 90 cents of our least favorite. We balance those risks. We don't want to drive tracking error because, number one, actually people don't mind tracking error if they always win. Okay, so we did try to preserve some of that, but same token, we want to underperform during periods. So what we did was we obviously made the 90-90 zero beta, didn't let small stocks really drive the return, and we actually matched our portfolio a little better, so we weren't as extreme in the 90 cents we liked. We bought the cheapest, short the most expensive, subject.
Well, as Joel just mentioned there, one of the goals of this approach is to reduce tracking error. But something to keep in mind when thinking through building this kind of portfolio is you don't want to overfit or get too close to the S&P 500 index in terms of your investments and the weighting of your investments, because then you just become what's called a closet indexer or an index hugger. So you want to track the index close enough so that you don't drastically underperform the index, but giving yourself enough uniqueness about your portfolio that you have a real opportunity to outperform the S&P 500 index. Well, let's get started on building a S&P 500 index beating portfolio. Well, as Joel just mentioned in his video, you want to start out with less obvious stocks to rely on them to really drive most of the mark or the index beating portion of your portfolio. It's assumed that you're doing a fair amount of reading, keeping track of what's going on in the marketplace, and you have some ideas of some stocks that are lesser known that you believe could be a good anchor to your index beating portfolio. So I'm going to start off with a couple of stocks that I feel like fit that bill. Namely, one is called Splunk, and another one is Tabloid, goes by the ticker Data. A third one is a pharmaceutical company, used to be called Valiant Pharmaceuticals. Now the ticker is BHC for Bosch Pharmaceutical. And for this video, I'm just going to leave it at those three. So I'm going to go ahead and do a refresh and have it bring in the current pricing information. And this video is being shot on a Saturday, so here on the previous Friday, it looks like Tabloid had a pretty good day, and actually Splunk and Bosch or Valiant also had some pretty good days. So it might have been good to have started this portfolio up a couple days ago, but anyway, that's the nature of these kind of high-flying stocks, is that when they do ignite, they typically are get the mass interest. They usually take off in pretty spectacular ways, and that's why you want to anchor your SP 500 Index beating portfolio with stocks like this. Now, it may be tempting to build out your entire portfolio with these kind of stocks that have high upside, but they also have a fair amount of downside. And Joel mentions earlier in his talk, previous to the portion that is part of this video, that if you were to make or studies that his company has done on portfolios, is that if you were to attempt to build out a portfolio of nothing but these kind of stocks, that you're going to end up with a lot of misses, that you're going to have a few hits. In fact, he calls companies like Netflix, which, if you would have known before, years earlier that Netflix was going to be a big winner, and if you could do that with all the stocks that you bring into your portfolio, yeah, you'd have a very high-performing portfolio. But he calls stocks like Netflix kind of the tyranny of the anecdote, meaning those kinds of successes are well known. And it to the point that it obscures, or people forget about all the other stocks similar to that at the time that you would have had bought into Netflix to ride up the kind of increase that has captured the attention of the mass market. More than likely, if you were to follow this approach, you would have more losers than you would have the big winners, and therefore your overall return would likely be considerably less than the SP 500 Index. So really what you want to do is once you've got a few of these high growth potential stocks, you want to now build out a portfolio with stocks that make up the S&P 500 Index. It is recommended you populate your portfolio with one of these top tier companies. Now, in this spreadsheet, we've gone with the top 6 companies being tier 1. And as discussed in other videos, these top 6 stocks make up almost 20% of the market cap of the S&P 500. So if you were to not include one of these top 6, you're running a real risk of not staying up with the S&P 500, because it just takes one of these 6 companies to do well, and if you're not an owner in that stock, you're going to underperform the S&P 500. So now the question is, well, which of the 6 would you bring in? Well, it's assuming that you're a subscriber to the Polaris Investing website, and you have access to the site to further review these numbers here that are the target theoretical investment returns, annual returns over the next 5 years. Now, they are theoretical, but relative to each other, you can see here that Apple, now it may not return 12.2%, but it was, take this link, go out to the Polaris Investing site, play around with the input parameters, and arrive at a practical valuation that you feel is something you can plan on. But just looking at the theoreticals, it looks like Apple. So for this video, I'm going to go ahead and just pick Apple. It's looking like it's the most likely one out of the 6 that will perform well. Probably want to stay away from Microsoft and Amazon. Not that they're not very good companies, but this looks like the prices have been bid up to the point that not expecting really good return. So this is an example of how you beat a market beating index, is you stay away from the likely losers, forecasted losers of the index, and try to focus primarily on the winners from coming out of the forecasted winners. So that's a tier 1 company. Next thing to do is to populate your portfolio further with some tier 2 companies. And as discussed before, the tier 2 represents another 20% of the market cap. So just between the tier 1 and tier 2, you end up with almost 40%. But unlike tier 1, which is just 6 companies, tier 2 consists of 20 companies. So you want to pick probably 2 out of that. So using the same approach, you scan down through these targeted rate of returns, and you see here that Bank of America has got a very high forecasted return, and I see I put in the ticker for Apple's AAPL. Bank of America has got a very high forecasted return. So does JP Morgan, but I'm not going to do 2 banks like that. I'm looking for something in a different industry. Wells Fargo, again, another bank. I'm going to go with Cisco Systems, CSCO. So there's tier 1, Apple, 2 tier 2s, and then these tier 3s make up only 10%. So I'm going to bring in I'm going to look for maybe one with a really high theoretical return. Again, you want to base your final decision on a practical, but I'm just going to do it based on theoretical here. Another bank, I see here Citigroup, but don't want to go with a bank. So let's go with IBM, another high-tech company. All right, so now we've got 7 stocks in the portfolio. Typically we want to go with at least 10 stocks. So now the remaining 3 would just be stocks that maybe you've read about that are part of the SP 500 that are outside this 50 portion that we're looking at here. So I'm going to go ahead and enter in Johnson & Johnson, a good stable company, although they've had pending lawsuits here recently, but assuming that they're going to work through those lawsuits. Another one is Procter & Gamble, and then a third one, let's do, is like Kellogg's. So I'm going to do a refresh to bring in all the pricing information about these, and you see here I've got 10 stocks in my portfolio. Now the default number of shares, talked about in other videos, is just 100 millionth of the outstanding shares. So for here like Apple, we have almost 5 billion shares, and then 100 millionth of that is this default share count of 50 shares. Now it boils down to budget. With buying 50 shares at $152, it close to an $8,000 purchase. So let's assume you've got a $10,000 budget. So now you add up all these here, and you see already you've got $20,000. So we haven't designated the number of shares we want to use for Splunk, Tabloid, and Bosch. So I'm going to lower this down to 40%. So it takes all these shares down, and now I've got a total outlay now of around $8,000. So I've got $2,000 to work with. So now I'm going to go ahead and enter in shares here. Let's say I'm going to start off with an even 10 shares each, and that brings in another $2,700. So the total is $10,870. That's in the ballpark of the budget that I'm looking at. So about a closer to $11,000 portfolio that I'm starting out with. You notice here that the stocks that we let default to number of shares, as discussed in other videos, it allows you to keep a relative weighting across those shares that are similar to what the weighting in the SP 500 Index. But by picking this number of shares of stocks outside the S&P 500, we've got almost 20 plus percent, almost 30% of the portfolio outside the S&P 500, and not in any way weighted similarly to the weightings of the other stocks. So this is where the real art of building a market index beating portfolio comes into play. Is how much do you go outside the S&P 500? How much of the S&P 500 do you incorporate into the index to give you some ballast of your portfolio to kind of keep you equally weighted and therefore maintain a tracking to the S&P 500, but at the same time giving yourself good upside potential. Obviously, the more you add shares to these stocks up here that are not part of the S&P 500, the more you're going to likely diverge from the S&P 500 index. So it really just comes down to personal preference as to how much you weight those stocks, or how many shares you buy relative to the amount of shares you buy inside from the S&P 500. Well, one thing we got to do next is we need to finish out the information, since there are not part of the S&P 500. These stocks here don't have the beta I'm actually brought in. So I'm going to go ahead and just quickly assume I'm looking those up and typing in some fairly significant betas associated with these high risk kind of stocks. So now I see the overall portfolio beta of 1.2. Now I'd also want to consider all the betas and not just take the blindly the historical calculated beta, but think through using the Polaris Investing site what the categorization of beta or risk is likely going to be in the future, so that I end up with numbers that don't tell me what was, but what I think will be in terms of the overall relative risk profile of this portfolio. Now, scrolling over to the right, you see here that the PE and the dividend yield. I'm going to do dividend yield first. All these stocks don't pay dividends, so which is typical of these kind of companies. And the PE ratios are pretty steep. I'm not going to go through and look those up right now, but I do need to have some idea, primarily using the Polaris Investing site, of what the target return is that I'm building in. So, assuming that we've gone out to the Polaris Investing site and comfortable with the practical valuation that's come out of that, I'm going to assume that was done, and I'm just going to put in 15, 17, and maybe 16% return. So now, and then I would do that for all the other stocks out of the S&P 500. Go out to the Polaris Investing site and replace these with practical investment returns that I feel are more likely to really happen going forward. Now, one here in particular you see here is Procter & Gamble has a pretty low return. I'm going to go ahead and assume we went out there and assume a little higher return for that. All right, then you would continue to fill in other information. And if you were to use save list, really at this point when you're filling in this much information, you really should store it out there on save list, and invite you to watch the save list video on how to do that. All right, so now we got everything in. We've got a target annual return of 13.3%, with the S&P 500 returning an average over many decades of around 9 to 10%. That is a market-beating index, and for most hedge fund managers, they try to beat the market by 5 or 6%. So that's within realm of possibility. I would assume maybe if we look through these some more, we might end up with a little higher forecasted return to make the in fact, let's say I end up doing just so we're chasing or something worthwhile. I'm going to up some of these a little bit more. At least get up to around above 14%. So we're getting that 5% type target range above the S&P 500 average return. And then the beta, so we have a relative risk versus the return. So this is looking like pretty much ready to go, but Before we finish out, you want to do a little review of make sure you've got a good cross-section of stocks. And a way to do that is you go here to the Manage tab and make sure that these two selections are on, and then come back. And now you can see here out of all the tiering. Again, we've talked about this in other videos, but we've got from this portion over here of 50 S&P 500 stocks, we've got 6 of the 10 stocks are from this portion. Well, when we built it, we purposely picked a tier 1, tier 2, and tier 3 stocks, and then these last 3 we also purposely picked to come from the S&P 500. But you see Kellogg's is not actually in the group of 50. Well, to refine that a little bit more, let's look specifically at tier 1. Yeah, we do have a tier 1. We have 2. Actually, because of the Johnson & Johnson Procter & Gamble, we now have 4 out of tier 2, and then tier 3 we have the 1 IBM. So I'm going to return this back to all. Orange now indicates where the highest returns in the most recent trading day have come from, Tabloid, and then Procter & Gamble. We can also look over here and see that Netflix had a high return, so we'd see how things are going very recently and whether that would influence our decision as to whether we want to bring something else in or take something else out. Now I'm going to scroll over here to the right and look at the different sectors that these companies come from. Now, Splunk, I'm going to go ahead and type them in. And Splunk comes from technology. And you want to make sure that you look at the sector names up here and type in the correct name. But technology, we have another technology stock, and then the last one is pharmaceutical, which is considered healthcare. So now we see that we have all 10 stocks identified up here as to what sector they're from, and we've got a concentration of technology stocks, which isn't unheard of when you're trying to really juice up your portfolio and beat the S&P 500. But you may want to reconsider maybe a little too much technology stock. Now over here we show kind of roughly what the categorization of risk and return typically is for different sectors. And yeah, technology is typically a high risk, kind of high return area, so it would make sense that we having a fair number of those in our portfolio. But industrials and getting some of these kind of medium to just kind of balance things out, may want to rethink that and try to end up with a complementary set of stocks that represent from various sectors. Although these rule of thumbs can be a little misleading, because you can have high return, high risk stocks in these sectors that maybe overall are being flagged as maybe low risk, low return. So you really want to look at the specifics of the company, and this is just a way to kind of, if you were to want to bring in some additional companies, kind of where to go shopping. Because here, if I wanted some more high risk companies, I would know that technology is typically where I'm going to find those kind of companies. And then if I wanted something more low risk to bring my beta down, I would know where to go at least start looking. And then you would drill down on that over here. So let's say I wanted to bring in a lower risk stock. I would look at the non-cyclicals and probably look at the whole, all the industries that make up non-cyclical. Look over here and see what kind of returns are being forecasted across these different industries, and then drill down on that and find a specific company that I'm interested in, or find a specific company to bring into my portfolio. So as you kind of wrap up your building out of this S&P 500 Index beating portfolio, let me return this back so you can get you want to kind of take a broad view of what you've done here. Real quickly, does it include stocks from the top portion of the S&P 500? So I'm looking for blue here. looking for more across the entire S&P 500. What kind of representation do I have? Have I brought in some potential high flyers to try to outperform the S&P 500? And then look at the beta. Do I feel comfortable with the relative risk that this portfolio represents for the return that the risk is targeting? And then, as we just talked about, also look at how your portfolio is split across the different industries to make sure you've got a good balance of exposure to the different industries. So as a final review, you just look at the budget that you've ended up with, around $11,000, and how you're going to invest that money across the different stocks in your portfolio. And then good idea to commit this to a saved list, and then monitor how you're doing. Go back out to the Polaris Investing site periodically and reassess how these stocks are likely to perform, and that's how you build a market-beating portfolio. So thanks for watching.